Hello and welcome to our video lecture for Chapter 5, Short-Term Investments and Receivables. First, we are going to learn how to account for short-term investments. First, if you have extra money as a company, what do? Well, you hopefully invest it in other companies. Sometimes you do this for strategic reasons, right? You want to obtain maybe influence over another company to possibly get hostile takeovers, or you want to learn more about it to see if it's something that you actually may want to acquire in the future. So basically, if you have excess cash and for strategic reasons, normally you would invest in other entities. Now, in order for it to be classified as a current asset, and remember that means that in less than 12 months or one operating cycle, that is going to be turned into cash, then it has to be liquid, which is easily convertible to cash. And also you have to intend, as in the investor, to convert it to cash within the year. That would make it current, or the operating cycle. And also you have to use it to pay for a current liability. So if you recall, our working capital formula equals current assets minus current liabilities. So you're going to use these current assets as investments to liquidate current liabilities. So some of the categories of these investments, we have trading securities, we have securities available for sale, and we have held to maturity. So make sure you have these in your Excel workbook: trading securities, securities available for sale, and held to maturity. So trading securities are usually some debt or equity, and it's really near term, so they're going to be active, and hopefully they generate income, not losses, on a day-to-day basis because of their fluctuating prices. Now, securities available for sale, in here you're holding it with some intent to get rid of it in the future, and this is like a catch-all. Securities available for sale, if it can't go into trading and it can't go into held to maturity, then this is the bucket that kind of keeps everything in there: securities available for sale. Also note that we've had some changes in FASB as of September 2015 that no longer classify securities available for sale. But you'll learn more about that in higher level accounting classes. So now, held to maturity securities. Here we're actually looking to keep them. So there's like longer maturity dates, and we intend to hold it until they mature. So most common examples are some bonds. You may have 5 or 10 year bonds, so we're going to hold them until that point. And so here is basically the type of security that you'll have. You have the type of asset, whether it's current or long term. And as you can see, both held to maturity and securities available for sale have current and long term. Also, the common thread is they're all recorded at cost, historical cost, with additional measures being fair value and amortized cost. And then you may have unrealized gains or losses, and this is another acronym that you should have: other comprehensive income, which basically means if you can't classify it as a gain or loss, then it's really unrealized, and because it's unrealized, you're going to put it in the other comprehensive income statement. And so we're going to discuss some of these in further detail, but for now, just realize it's historical cost. You may have to subsequently measure it to fair value, and more likely than not, trading securities, which is what you're most concerned with, will go in the income statement. So let's go through some examples and make sure we understand how to post journal entries. So the first one we're doing has to deal with trading securities. And so now we have that on June 18th, Apple purchases 5,000 shares of Intel stock as a trading security. Now, for simplicity, suppose that Intel stock is Apple Inc.'s only short-term investment. So Apple buys the Intel stock during 2014 for $20 per share, so they're paying $100,000. So basically, we're taking our 5,000 shares times $20, and then we get $100,000. So how would we record the purchase? So first and foremost, as I always say, is what's happening to cash. We are making a purchase, so cash is going down. So we're going to credit cash for the $100,000, and then we're going to have investment in trading securities. And we might see it just like this on your exam: investment in TS for trading securities. So very straightforward entry. Now let's assume that we receive a cash dividend of $4,000 from Intel. So now this is dividend revenue, and we know that revenues have, if we're looking right? So we have revenues, they have a credit balance, and so in this case we received money, so we have cash for $4,000 and we have dividend revenue for $4,000. So trading securities are reported on the balance sheet at their current fair market value. Fair market value, you should have that, and fair value. So their fair market value. So if the value has increased, what we have is known as an unrealized gains. They only become realized when you sell the asset, if it's a gain. And the same thing, if it's decreased, then it has an unrealized loss, and it would only be realized when you actually sell it. So make sure you understand the concept of unrealized. So now let's talk about how to record these unrealized gains. So now we're back to Apple in our 2014 fiscal year, which ends on September 31st. And now this is ending, so it is a fiscal year as it says here, because remember, calendar year would start in January and end in December. So because this is a different date and a year-end date of September 27th, it is a fiscal year. So on that last year-end date, the fair market value of the stock was now $110,000. So what we have to do is adjust the investment to its current fair market value. So how we would do that, since it's going up, we're going to increase our asset, right? Because this was our beginning balance here of 100,000. So we need to increase it. And then we're going to have in this unrealized, because we haven't sold it. So basically this can go down tomorrow like any stock. So in this case, we're just recording it for financial reporting purposes. So we're going to show the 10,000 here, and then we're going to show the gain. Excuse me. So now you see, we now have our asset value at $110,000. So now if we're saying on September 26th, if that is the year end, then here we have the fair market value as 105. So in preparation for its balance sheet, what we're going to do is, okay, now we have to reduce it, right? Because we had it at 110 here. You see these two amounts. That's what we did it earlier, but now we have to prepare our financial statements. So now we're going to do completely the opposite of what we did to make sure that this fair market value is correct. We normally only do this at year end, possibly quarter ends and year ends, and we try to just what we call true up these and adjust all of our investments accordingly. So now when realized gains or losses, it is only realized when you sell it. It's unrealized to show all the fluctuations of the fair market value. But once we sell it, now we know the sales price, right? So if our sales price is greater than the carrying amount, which is the amount that we're recording on our books, right? Amount on our accounting record. Then if we sell it for more, we have a gain. Obviously, if we sell it for less, we have a loss. So let's go through this example. Now we are selling it for $107,000. So we get $107,000 cash. That's the easiest way, right? Always what's happening to cash. We're selling the stock. And then, but notice remember we put it at 105. So we had it at 110, you'll recall, right? We initially had it at 100,000. Then we added 10,000 to get it to our 110. And this was unrealized gain. And then we had to reduce it to 105, which is now our balance. And this is now another unrealized gain, right? But because we're reducing the fact here. So then we have to make it tie. So we have $2,000, which is our gain, and this. You could also write here realized gain, which is a bit redundant, but if that makes it easy for you. In industry, we normally just say gain or loss, and then unrealized signifies that we're just truing it up for the fair market value. So let's move now to our securities available for sale. Securities available for sale. So we treat this very similar as trading securities when we're recording the actual purchase and the dividend, and the same thing when we're adding and adjusting to our fair market value. But now the differences come in when we're talking about unrealized gains or losses. Instead of reporting it directly onto the income statement, we report it as other comprehensive income. Other comprehensive income. So, and then what we have is what's known as accumulated other comprehensive income or loss, and that gets placed in shareholders' equity. So in this case, all you have to note is that here is on the income. So here's our investment, and this is our trading securities, right? So here was our 110,000. Then the year later we had 105,000, and here it's zero because we sold it. And so here, when we remember, we initially bought it for $100,000. So here's our 10,000 unrealized gain, and then we lost 5,000 of it. And so then once we sold it for 107, so we had the 2. So all the entries that we did for trading securities, now we look at it here and we see how it looks not only on the balance sheet, and remember your balance sheet assets equal liabilities plus owner's equity, and remember your income statement is revenue minus expenses equals your net income. So now for securities available for sale, I don't use these acronyms. We've been using SAS for so many years. So it's securities available for sale. We have the 110 and the 105 and the 0. But now the difference is we don't show unrealized gain or loss, right? Because we don't show that. We actually show the 10,000 and the 5,000 exactly like we did if we go back right here. But on the income statement, now we're showing it as part of stockholders' equity as accumulated other comprehensive income. And notice we have a higher gain here because it's 7,000. Here we had 2 with our trading securities, but here we have 7,000 because we're actually not recording anything, right? It's staying at our amount here of 105 with our accumulated going there. So hopefully that helps you understand that. So let's go through another example. Eastern Corporation is an investment banking company and it has extra cash to invest. So let's say that we buy 1,000 shares of Dream Inc. at $57 per share and assume Easton expects to hold the Dream stock for 1 month and then it's going to sell it. The purchase occurs on December 31st, 2014. And at December 31st, the market price, we bought it for 57, but the market price is 58. So what type of an investment is this to Eastern? I'll give you a minute to answer. Hopefully you said a trading security, right? Because you're going to do it within a month, right? So right here we have that 1 month that tells us, hey, this is a trading security. So now we want to record the purchase of the stock on December 15th and the adjustment to the market value. So we bought the stock, and remember we had 1,000 shares at $57 because we're going to adjust it to the fair market value of 58 in our December 31st entry. But right now we bought it for 57,000, so cash is going down and we have an investment in trading securities. Then when we're adjusting it, it went up, right? So now we have $58. So we're going to multiply that. So basically this is 58,000 minus 57,000. So we have $1,000 that we need to increase. And since we did not sell it, it's an unrealized gain. And since it is on the trading security, this would be on our income statement. So now we want to show how Eastern would report this on the balance sheet at December 31st and any gain or loss. So we see, let's go back here. So we see our partial income statements here. So we see the 58,000 and we see the 1,000 here as unrealized gains and losses in our income statement. And notice we have it at the 58 now because we have that 1,000 that we added, not the original 57,000 that we purchased it for. Okay, now suppose that we did not, keyword there, intend to treat this as a trading security, but we intended to treat it as a short-term investment. So now what type of an investment would it be? We would actually say securities available for sale. We don't know if we're going to hold it to maturity, and we definitely know that it is not trading security because we're holding it for a longer period of time. So now we're going to say securities available for sale. And we are actually going to record this the exact same way. The only variance here is that we're calling it securities available for sale instead of trading securities. But as you can recall, the initial investment and then the unrealized gain are the same. The only difference is that instead of this being on the income statement, it is on your other comprehensive income, and that is part of stockholders' equity. And then now you see that we have this new addition here on our balance sheet, and you see that that we only have $1,000 in our other comprehensive income and in our statement. So there's nothing here on the income statement. So there's no income statement impact here because we're doing it to stockholders' equity and to our other comprehensive income. So our entry is going to be debit other comprehensive income and credit our accumulated other comprehensive income. Okay, so continuing on, we have ethics in the current ratio. You want to add this in Excel. So your current ratio is total current assets divided by total current liabilities. And you want to increase this. You always want your numerator to be greater, right? So you want to make sure that you have enough liquid, because current assets are liquid assets. Liquid meaning that we can convert them into cash quite readily, and you want to make sure that we're there so we can pay off any current liabilities, and basically we want to make sure that we have enough cash to do what we need to do. So if this number is 1.0 or greater, it's good, because that means 1.0 means we just have barely enough. Anything above that is a really good number. So we're going to stop this video here, and we're going to pick it up on our next video.